And in private investing, the benefits are there. If you really want to accelerate, I mean, the difference between making 7% a year after taxes and making 20% a year after taxes isn't 3x, it's exponential. I keep trying to say that to folks, not selfishly, but because it has personally changed my life. I went from having a 10K net worth to really putting myself in a special position where I get to do fun stuff, spend more time with my family.
We've got some properties in the hood neighborhoods where there have been shootings and problems happen. But now we're actually live time dealing with the new problem that never expected, ICE.
Yes, absolutely.
How do people actually pay for multi-million-dollar properties? There's not a secret sauce, but there's a way that it takes place, and we call that the capital stack. And so today we're back with Gabriel Craft. We've checked out the property. It's multi-millions of dollars. And you know what? As successful as the guy has been, he doesn't have that in his piggy bank. So we're going to dive into how to actually afford these big opportunities and what it actually means. Thanks for making it back again.
Thank you. It's just so fun to be in your studio. Last time they came in, I was impressed. I was like, gosh, you got all the lights and all the set, all this beautiful artwork. So thanks for having me in your office, Nate.
Well, let me just share with this artwork because there are old ads from like the 1920s, 1930s. I actually have this ad from the 1800s. Cocaine for the hair. It solves dandruff. It solves the itch.
Oh, shoot. I wish they could sell that on Amazon. Somebody out here to cover up these bald spots that I'm developing as I get into my 40s.
It solves baldness.
Let's go. Let's go. Wow. Yeah. Well, I love your setup and thanks for having me back on. It was cool to see you guys out at the property. So super excited to talk a little bit more about Tower Village.
Definitely. Well, let's dive into it. What's the purchase price for the entire thing?
Yeah, let's walk through some of the numbers. We're buying it for 27.1. So that's how much we got to fork over to the seller.
Okay.
With that, though, we're going to raise our own CapEx funds. We've got 4.6.
What does that even mean?
So we're going to, all the upgrades, the painting, the foundation, the roofs, the plumbing, all that money, we're going to raise that in addition to the 27.1 to pay the sellers. We're going to raise 4.6 million to pay the contractors to fix the place up.
So you're going to need basically $32 million to net this deal out.
Yeah, absolutely. And look, there's even a little bit more for closing costs and a little bit more for
attorneys,
operating expenses. Yeah, you guys are not that bad. You're not the worst in the whole world.
Don't worry, we'll raise our prices.
You're the least of my worries on something this size. A lot of it comes down to just making sure you're well funded. That's one of the things I do is I buy older properties. This is from the 70s. So we always got to make sure there's a lot of sleep good at night money on this deal. We're raising about $1.2 million extra money reserves to kind of make sure that we can keep this thing rolling.
So now we're sitting at $27 million to buy it, $4 million to improve it, another $1 million of just sleep well at night, making sure there's reserves there.
Yeah.
That's a big undertaking.
It's a huge undertaking. And that's one of the reasons why it involves a huge team. And one of the reasons why Craft Capital Investments isn't just Gabriel Craft, now me, but I've got my CFO and my COO, as well as some other folks that we partner with in terms of like Aaron Katz, multifamily investing, apartment investing, I should say, and others, right, that come in and support, maybe even behind the scenes as what we call a key guarantor or key principal on the loan.
Okay.
And we all come together because we need to talk about how to actually finance these things. Yeah. My biggest investor, every single time I do a deal, it isn't, my sister who's put in a lot of money on the deal that you guys did the legal work for us. It's not even some of my other key principals that put in large checks, maybe 7-digit numbers. It's the bank. It's always the bank.
Right.
Our biggest investor is always the bank. And on this,
I want to just point this out.
Yeah.
The bank is an investor.
Yes.
They're doing their due diligence. They have more stringent requirements, but they are investing in your success. And if you're not successful, sometimes they take losses too. So you can't think about a bank as just a pot of money in a piggy bank. They have a lot of requirements going along with it.
Yeah, as I learned more about banking, look, they borrow the money from people to lend to you. So like they're making money on the margins. They've got to do their homework, and the stuff that they ask you to do is actually very reasonable in the long run. They're asking for sort of, what would make sense here if I wanted to make sure that I land the plane 99.99% of the time and get my money back at the end with my interest. So yeah, they're our biggest investor. And to make sure that they're happy, there are some requirements we have to meet. First of all, we have to follow all the SEC guidelines. So that's sort of where you guys come in as we go to bring money into this thing. But they're also looking to see if you have experience, right? So do you have enough experience in this space? Have you gone full cycle? Nobody starts with enough experience. It's a little bit of chicken before the egg. The way you typically would get involved in the type of loans that we do, which we either get from Fannie Mae or Freddie Mac, we call those agency loans. Those are the big government-backed agency lenders, although they're both trying to become privatized again, but whatever. They're huge lenders.
Let's try to stay out of politics, but when we talk about these loans, there are a lot of politics that affect them. So
when we talk about these deals, there's a lot of macroeconomics and news and politics that we have to stay tied to. Like I was apologizing the other day to an investor for sounding like a CNN news anchor, but was talking all about interest rates and inflation, et cetera, because it does impact these deals real time as you get into it. And the only people that are behind the scenes dealing with all this are me, my investors, and my legal team, because we're always running around pivoting every 10 seconds.
Let me share a really weird politics affecting property. And I never would have expected this. I shared with you in the past that we've got some properties in the hood neighborhoods where there have been shootings and problems happen. But now we're actually live time dealing with the new problem that never expected. ICE.
Yes, absolutely. Yeah, definitely.
There's a lot of tenants in our buildings that have just decided to leave to self-deport.
Yeah.
And all of a sudden our occupancy rates have dipped quite a bit. Yeah. Again, 100% because of politics. So we can't ignore that is a consideration.
Yep.
Also, if the immigration issues subside and go away, naturally that occupancy is going to go back up.
Yep.
So it's like you have to pay attention to all this stuff at the same time. But now I'm just digressing.
No. This is great. I mean, I think the idea is like you got to keep your head above the water and pay attention to all of it if you're going to be any good at what you're doing. And it does start sort of back at the basics of a deal. So you got to have a well-funded deal that starts with the bank. I think I mentioned some of the requirements there, although a couple that I didn't mention would be having a team that has the net worth and liquidity. The banks typically want to see some of that.
What's the requirements on the net worth?
So for net worth, you've got to look at net worth not with your personal home. So outside of your personal home, they want to look at what's your net worth and does it match the loan amount is typically what we're looking at. So do you have net worth equal to the loan amount amongst all of your guarantors?
Also, key guarantors, key principals.
Yeah.
Can you define who they are and what they do a little bit more? Just
somebody that's not going to have any control of the deal. They're not going to be an asset manager. They're not going to be what you would consider to be raising capital on the deal, but they're putting their name on the loan and they're responsible if things go south on the loan. And for that, they typically maybe you get a little compensation, or in the case of a Fannie Mae or Freddie Mac loan, sometimes people will do it so they can gain experience. There are two qualifications that matter a lot right now. There's either experienced operator or less experienced operator. It's called a LEO. And that means somebody that doesn't have any Fannie Mae or Freddie Mac experience. It adds month or more to the process if you're a LEO, if you're a less experienced operator. You could have experience 15 debt fund deals. You could have been the single family guru with 86 transactions. It does not matter. Your process will be slowed down and you may not even qualify at all if you don't have significant experience with Fannie Mae and Freddie Mac. So again, chicken before the egg. Right. I kind of got to get brought into a team that has some experience like I did on my third deal.
But she nailed it. It's the team, because it doesn't have to just be you. You come to the table without experience.
Yeah.
You come to the table not necessarily with the net worth.
Yep.
That doesn't mean you can't get deals done, but you sure better expect it to be a team sport rather than a solo venture.
Yeah. And look, now in the beginning, the people I did my first deals with, they brought me in and somehow allowed me to get signed on these loans and get the experience, and I had no net worth, that very little net worth, I should say, and not enough to be meaningful and no experience. Now I have both experience and net worth. So sort of they've created an opportunity where if we needed to partner together, they could go do even bigger and better deals because now they kind of created somebody with some net worth and with some experience. And so it kind of helps you grow as you come up. If you can include people that maybe don't have the experience and bring them along with you. And those people oftentimes have to find somebody with more experience like me, you, that can sign with loans.
And that actually is something that you do or open to do or looking to do, is bringing in the younger, less experienced people to partner with to make more of these deals happen. Is that true?
Yeah, I love watching that new energy come into opportunities. Now, these have got to be the rare exception of people out there that are going to kind of bubble to the top. I may invite 10 people to partner. 5 of them will do the work on the front end. We may get involved with 4 or 5 others. And one of those is going to stand out as somebody that I'll do consistent work with because they're doing all the work, they're showing up to the calls, they're doing the small things, and they're easy to do business with. And people lose sight of that, but you guys get it, right?
Okay.
You deal with everything under the sun, but you only want to do repeat business with cool people. And look, it's to each his own, the definition of cool, but you also know an asshole when you see an asshole. And I think people overlook the just being easy to do business with. It's the basics in this commercial real estate or any of the other asset classes that we could talk about.
I gotta be honest. I knew I made it when I could fire the asshole clients.
That's the best, right? That's absolutely the best. Yes, that's when you're like, all right, cool. We just will not work with that dude, right?
Completely.
Yeah, and that's like sort of something that is a privilege, right? Because in the beginning you're just trying to grind and do the best that you can. But I think it's highly, highly important that if you don't have the skills and you don't have the experience, at least be cool, at least be easy to deal with.
Without a doubt. All right, now we're talking about the bank.
Yep.
There's this debt to equity ratio that needs to be maintained. Not getting into this particular deal, but kind of what's the range of debt to equity? Meaning, if you have to raise $30 million, you can borrow up to so much money from a bank, but then you have to bring in other capital elsewhere. About where is that defining line?
Really kind of depends on the business plan here. If you're buying a hunk of junk with a whole lot of value add, you probably won't go the same route that I'm going on this deal. You're allowed to sort of borrow, we'll call it 70% of the purchase price, but you could get 100% financing on all your capital stuff. So, ends up being about 75 to 80, even 83% leverage if you want to go up that high. If you're doing something that I'll call sort of a bridge loan into a better, more stable loan, one of these debt fund loans, a small bank or some kind, something that involves a little bit more risk, probably a higher rate, but a little bit more capital to help you get there in the beginning. When you're working with the agencies, Fannie Mae, Freddie Mac, they're looking for something that's stable. They can sort of, for sure, cover its debt service plus 25%, 30%, something like that. So in order to stay into that kind of debt service coverage ratio of pay for all of its debt plus 25 or 30%, you're going to need to usually leverage in about 70 to 75%. Some extraordinary deals, you can get up to 80%, but then you're going to raise all of your own money for CapEx, all your own money for any of the extra stuff like closing costs. So, and at the end of the day, everything rent lands around that 70 to 75 is sort of a very standard commercial real estate, at least on the apartment investing side, where you're going to get from the bank. The rest of it, you got to raise.
You said a word, bridge lender.
Oh, yeah.
Because that changes the dynamic completely.
Yeah.
Could you explain how a bridge lender can work into a capital stack and what that actually means?
When a deal's in trouble, when the agencies won't fund it, when it hasn't been operating well, maybe ICE came through, scared a bunch of tenants off, and owners were in New York or Los Angeles, and they really didn't spend time to kind of go there all the time. So they didn't catch it until 2-3 months down the road. And then their management company is like, hey, we've got a problem here. And we're, sort of sitting in a position where, we wanted somebody else to buy the deal. Somebody buys a deal like that that's in a lot of trouble. They're typically going to need a loan that's a 2 to 3 year loan, maybe 4 or 5 years, but something to bridge the gap between being in a bad spot to being in a solid position. And so we like to call those the 3-year loan options because you can extend them a year or two at a time after that. But really you're going in with like a 3-year business plan. They'll give you a bunch of money to throw on all the CapEx problem and deferred maintenance, but you've got to solve the problem of occupancy and operations and have a cool business plan for spending that CapEx money. Those are called bridge loans. Okay. They will depend a lot more on the future value of the deal instead of an agency loan, which depends on, hey, how is it performing right now? Is it producing enough capital? Because I'm only going to give you money for what it's doing today. Bridge loans will look out to the future and go, hey, I think you could make this thing go from A to B. And so I'll give you a loan based on that.
So let me just restate that. You can't get a permanent loan because you need to improve the property, whether it's occupancy or value addition. So you can get a 2, 3, maybe 5 year at the most loan to take the property down to improve it and then refinance, get a new loan from the agencies to have more of a permanent financing situation. Is that a good summary of how it works?
It's a perfect summary. And the only thing I'll just mention is like, there's nothing wrong with either of the types. You really have to look at your business plan and see which one fits the best, because a lot of times if people think of the Fannie Mae or Freddie Mac loans as the better loans, that's a big mistake, particularly in moments like we're seeing right now. In the past, when you've had a lot of value creation opportunities, so 2010, 2011,
Right.
if you lock into too long of a loan and it doesn't match your business plan, if you want to turn it around in a year or two and you lock in a 15-year loan, you're going to have a huge prepayment penalty. That loan is going to be extremely expensive. We're talking millions and millions and millions and millions and millions of dollars that would prohibit you from selling it.
Prepayment penalty means that you pay extra to pay it off earlier.
Yeah, because the bank, when they send you that loan of 15 years or 10 years or even 7 years, their expectation is you're going to keep it until darn near the end of the term. If you try to sell it early, they're going to want to still collect the same interest that they would have gotten, either through something called yield maintenance or through defeasance, both of which suck if you have way too long of a loan and you don't have a business plan that matches it. So we have some deals that we plan to hold for 3 years, like the one I just did in September. We went from 80% occupancy to 99% occupancy. That thing has a 3-year loan on it. It's perfect. We will sell it in 2.5 or 3 years, have almost no prepayment penalty, and our investors will make a lot of money. But it would not fit for that Tower Village deal that you got to come and see. That thing is stable. It's doing really well currently. It's pumping out cash flow. And because the purchase price is so low relative to sort of how much income it's creating, we get to use an agency loan. And we probably want to ride that out for a little bit longer. It's a great location. So we want to see what it looks like in 5 to 7 years. Is the market super exciting again? And if that's not the case, we won't sell it until 4, 5, 6, 7 years into the hole.
Okay. So that's the debt side. And that can take up 75, give or take 70 to 80% of the purchase price and all these additional expenses that come along. Then we have the other side, which is, I think, the funnest part, working with investors, raising capital, bringing in that other money. Can you speak a little bit towards what that actually means for the deal? Not necessarily the process, but for the deal. How is that important?
Well, you look, if you can't raise money, you can't do deals, right? Because at some point you're going to run out of cash. I love my friends that are small business owners. They tend to do a lot of deals where they'll put in $1 million or $2 million of their own money at a time. But these things have gotten really expensive. So if you want to stick to that range of professionally managed assets, 100 units and more, we're talking $10 million. We're talking at least $3.5 million equity of cash that you're not going to get from the bank. And that can be really tough to do consistently. So if you can't raise capital, those are sort of off limits to a lot of people, to most people. The equity that we source is just one of many ways you can source equity. We source equity from a community of investors that for the last decade, for me, and then for some of my business partners for the last decade and a half, have been coming to educational events, a sort of education first equity raising. And so that's where you get people into the space to learn about private investing, how it's different from public markets, what it means to put something away for 5 to 7 years and how you should expect a much better return. What do the tax benefits look like in this space? What are other things that it provides you in terms of differentiation, right? Because everybody's investing should come down to 4 things. You should be able to protect your money. You should be able to get some cash flow. You should be able to grow real fast. And you should have some diversity so that when the stocks go up, yours may not go up, but when the stocks go down, yours may not go down. You want to be able to have 4, 5, 6, 7, 8 things coming in as you get to a place where you can afford to do that.
We call that uncorrelated investments. You're not subject to what the stock market is doing.
Yeah.
And we know right now it's going up, down, left, right, BA start.
Yeah, S&P lost 5% just because we announced we were going to go to war with Iran. So I think at the end of the day, stocks are very volatile, but they're also amazing. And so I'm not the person to get on here to talk bad about other types of investing. My sister came to me. She has an opportunity.
Diversification.
Yeah, she came to me with an opportunity. She's like, I got $1 million. She was like, I want to put some of this in private, or she wanted to put all of it in private funds, I said that's a bad idea. Like, you should take half of it. If you don't want to get good at stock investing, just match it to the S&P 500. Do what you do with index funds, because I do believe in the public markets. A lot of what we're going to see in terms of growth will come from public markets. But if you only have those when times get tough in the public markets, or if it all goes to hell in a handbasket in public markets, you won't have that diversity that we're talking about. So we offer that. We aim for investors that have, opportunity to invest about 100K. We like to aim for accredited investors, so people that make more than $1 billion, or if they're single, they can make $200,000 a year at their job. And if they're married, the couple should make $300,000 more a year at their job. The hard part there is it needs to be the last 2 years. So it's not like you can just all of a sudden get a pay bump and then you're accredited. You got to kind of qualify that way. Although I think you would know better than me. There's soon to be some new ways to get accredited, right?
I just got to be honest. I'm glad that I'm not the one talking about it for once. Thank you so much, Professor.
No, I mean,
it is important, though.
It's important, and there's some reasons why it's important, but we won't get into those. It's just that, what the government's trying to do is protect the little old lady that's got 50K in her bank account from being robbed. And so there's a lot of really good reasons behind sort of setting up some rules around who can invest in these private things, because as great as the private markets are, they probably have the most fraud or misdirection or opportunity for full loss out there, just because it's so heavily dependent on the person. And you could say something and not deliver on that in the private markets. The public markets kind of work for two big public companies, right? Well, one was private, I guess, but two very large companies that are publicly announced and get publicly audited. When you've got third-party auditing from great firms like PwC, one of the firms I used to work for, you have a lot of clarity around what's going on. And when you talk about these private investments, anything can go.
You say that, but you can also see stocks drop 50% in a moment.
Sure.
So these things definitely happen. Kind of the point being the diversification between public markets with private assets, between real estate, maybe even into private goods or hard precious metals. Like that diversification will balance out a little bit of that huge swings up and down. So I agree with you that it's important to stay diversified, equally important to be in real estate, which has created more millionaires in America than any other asset class there is.
It happens quick. I think real estate is the only space where you get in, and the more you learn, you're upset because it's better than you thought. Most things when you get in, like stocks is a great example, or even small business, you get in and you're like, wow, that looked easy from the outside to open my own Jamaican restaurant, right? Jamaican food restaurant. But it's like so much harder to actually deliver and make any money, or, even like any small business.
Okay.
When you get into real estate, you're like, oh, I didn't realize I could do this and save money on my taxes. Oh, I didn't realize I could do this and lower my expenses and make even more profit. So when you get into real estate, I think it's one of the few exceptions where you're just like, oh man, the prize inside of the box is actually better than we thought it was going to be. And you really got to get to learn over maybe a 6 month to 1 year period before you dive in, or whether you're doing self-storage or multifamily like I do, or any of the other wonderful asset classes out there. But once you do, you've now got this new tool to add to your investing opportunities outside of stocks.
So we have the bank. They're coming in with 7%.
Yep.
Give or take. Then we have investors,
Yep.
and they're coming up with all or most of the rest.
Yep.
How do you feel about the sponsors, yourself, putting in money?
Well, the beautiful part about getting these really established loans is you've got to be able to put money in yourself. So they won't give you a loan anymore if you're not putting in a significant portion. We put in between 5 and 15% of that equity. So on the deal that we're talking about, we're actually going to raise 14 million, and our team is prepared to come in anywhere from 750K to 1.75. That's kind of the range where you can. And that's because, right, where you put your money where your mouth is. In the beginning, I did not respect this. So in 2021, I did a deal and I was like, why would anybody care if I put a bunch of my money in? Because I'm making money when they make money. So of course I've incentivized on the upside to do really well. In fact, I'm going to make as much money as possible for my investors because I get paid on the upside. What I've learned as I've watched people lose the money that they invested in, and look, this hasn't been on our deals, but this has been on many of the deals around me. It's part of one of our differentiators why we're still surviving and doing well, is because we've been able to maintain people's capital. But on the deals around me, as things have fallen apart, what becomes clear is when that share of the upside of the profits, when profits become zero,
Going.
the person in control of the deal needs to still have some motivation to keep things afloat. Otherwise, they're going to start to lose all of the equity in the deal. And when they don't have any money in the deal, they could care less whether things are starting to fall apart. I'm not saying that always happens. Some people just come from a good spot morally. But outside of morals, having $750 to $1.75 million into a deal is going to be a great motivator to not lose any money because such a big portion of it is yours. So between 5 and 15% is sort of what we aim to put in our deals.
Well, I do want to throw out one thing, because when you're doing deals, you are charging management fees. And I have a different opinion than plenty of people. I think it's so important to have a management fee, because if things don't go as planned, you need to make sure that the GPs, the sponsors, the operators are still incentivized. Not just incentivized, but they can keep their employees paid. They can keep their lights on. So when you see management fees as part of a deal, I say that that should be the case 100% of the time. Investors, you shouldn't look at it and think, oh, well, these guys are going to make money anyways. That's not the incentive. That's the fallback.
Yep. And look, for fees, I see a lot of newer people jump in and they try to charge as low fees as possible. Huge mistake, right? If you don't have value for the work you're doing, then at the end of the day, you're going to do a terrible job. And so the fees substantiate the work. One thing that we've done a little differently, so we'll charge a pretty big number up front on the acquisition side. You know, some people don't like the front end. I know how much money we have to put up, how much risk we've been taking on, and how my team works on the acquisition side. There's 155 deals that came out between last October and are getting under contract in April on this deal. We underwrote all of them, or at least we screened them all out. And that's part of that work, going on tours, missing deals, coming in second place and third place on deals. And so acquisition fee, I feel no way about it. We're in a growing situation with our business. So we charge a pretty hefty front end. And that's just one thing I'm proud
Part of the business.
3%. What we've done more is reduce the asset management fee. So we're about 0.5% to 1%. My team does a ton of asset management, but we sort of bake that into our split. We feel like we've seen too many sponsors that get out there and they're making big asset and property management and acquisition fees, and then they leave very little incentive to do a great job for the end. Especially because what we're asking people to do in a lot of scenarios is sort of wait until we turn our property around. We do heavy value adds a lot of time, and you're not going to see a whole lot of cash flow in the beginning. So we kind of keep that alignment. We'll tell people we're not going to charge any asset management fee until we start getting distributions. And that's just sort of a unique way that we positioned it, because we like that alignment. I think at the end of the day, it's all about alignment. You want to be able to invest in stuff that has best in class people, because people are the most important part of these investments, as you've learned, passively investing in other people's stuff. But then you also want to make sure that, you know, the investors get paid when you get paid. And that's kind of always been our motto.
And I do want to point something out, is you get a share of the profits.
Yeah.
Y'all are doing this as a charity.
Absolutely.
So the capital stack is the bank. It is the investors. And then there's profits on top of that. That's the reason why you're in this business, that you're doing these deals, that you go through all of this work. Hence, that's also where millions can be made, right along with the millions your investors are making as well.
It's attractive for investors, right? So you got to think about it. Like most of the time, if you were my neighbor and I was trying to convince you to do a single family flip with me, and I said, hey, I just need money, but I'm really good at flipping houses. Typically what that's going to look like is like a 50-50 share,
Yep.
right? So like, I'm going to get half of the profits, do all the work, but take your 100K, leverage it a little bit with some hard money, and then hope that we
Hopefully
make good money,
two.
make some money. Yeah, hopefully it makes 2. And then you're going to get 50 of that profit. I'll get 50 of that property. In multifamily, it's a really established thing. And ultimately, you're looking at a split somewhere between 70% that goes to the investors all the way up to 80, 85%. Oftentimes, sort of it changes even in some scenarios like we do on our deals if you put in more. So the more you put in, the better split you.
And you have complete flexibility if you're putting together a deal, that some investors get returned X based on how much they put in. Other investors put in more, they get a little bit of the bigger split. We've also done it where the earlier investors will get more. If you're doing like a multi-phase development, like you're taking a property down, then you have improvements, then you're building another building, then you have it stabilized. There's different phases that can come into play, all of which the investors may have different incentives at the same time.
You reminded me of something. So last time I came in here, in our first conversation, I talked a little bit about where I started.
Yeah.
But I distinctly remember that in my first investment as a passive investor, 2018, I took my paperwork to you and your team at Dodson, and it was $750 or something super simple like that. But I had somebody from your team sit down with me and walk through every page of the offering, because there's a lot of things that you learn and do in that process. And I'd say that if there's people that are watching that are newer investors, and you've never done that before, even if you've done 2 or 3 just because you like to the sponsor, take that paperwork and show it to a professional and have them walk you through what everything means. There were literally 2 character words that changed everything on a page. One example is like return of capital versus return on capital.
Oh my God, I hate that.
And I freaked out when I learned that from Richard. He was just like, hey, the attorney on your team, he was just like, hey, actually, this means something totally different than you thought it did, right? And it doesn't always line up with where you would think in terms of the professionalism of some of these sponsors out there. You might look at their paperwork and think they know what they had in there, but sometimes they don't even know what they had in there. So a legal professional, somebody that really knows their stuff, put the paperwork in front of them 1 or 2 times. You don't have to do it every single time. You will learn what to look for in that walkthrough, but highly advisable. Is one of the best $750 I ever spent. And it really taught me that when I was ready to become a sponsor, which I became 3 years later in 2021, that I needed to pull a lot more energy and effort into understanding that part of the business and staying on top of it, because things change.
And so if you're an investor, you got to be doing your due diligence. You have to make sure that you're working with good people. The legalese, that's also really important. Make sure that you're still working with good people that understands and knows the deals, the structures, what's working in the market, and also can help you with that due diligence as well, because there are always risks in investing. Same applies if you're going to sponsor an investment, raise capital from investors. Always want to make sure you're working with a good team, and that does include a good legal support, so that, again, you're doing things the way that the market expects, that it's sellable and attractive to investors, and then at the same time, CYA, cover yourself, make sure you're staying out of trouble.
And then it makes it a lot more cohesive through the life of the whole, because everybody's on the same page. Look, a lot of this breaks down into just like making sure things are really clear for investing. And in private investing, it's the one space where you have to be a little bit more on top of that than you would if just say investing in JP Morgan stock or Amazon stock, right?
Totally.
Because it's a whole different ballgame. But the benefits are there. If you really want to accelerate, I mean, the difference between making 7% a year after taxes and making 20% a year after taxes isn't 3x, it's exponential, because of the way things will grow over a 10 or 20 year period. And again, we talk about diversification. So just even the natural sort of feel good of knowing you got some money coming in from here, 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 and here. So at the end of the day, if one of these falls off, the other 3 are still producing. It's a no-brainer to get good at this space. I keep trying to say that to folks, not selfishly, but because it has personally changed my life. I went from, having a 10K net worth, had a lot more cash than that, but had a bunch of student loan debt, to really putting myself in a special position where I get to do fun stuff, spend more time with my family, and ultimately have that flexibility to not have to be that W-2 employee that I talked about last time when I was on the show with you. I'm just kind of not happy with where I was at.
You're an entrepreneur, yeah.
Which is scary. Scary.
One of my favorite sayings the client once told me, I love entrepreneurship. I love the freedom to work any 80 hours a week I'd like.
Absolutely. And it's a weird one too, because the first 5 months after I left my job, I realized how much of my identity was tied to my job. It was, I'm a this at this company. Like when people introduce themselves at parties and stuff, like that's what they lead with.
What do you do?
Yeah,
well,
what do you do? And it's so fun to not be in that bucket anymore. And to have an awkward answer, just like, I don't do any of those things. I run my own business. But it is a harrowing journey in the beginning. And so I think this is a space that is really an interesting one when you have enough of your own parachute built with investing, with the backbone of passive investing. It allows you to be more flexible. I'm sure for you and your legal business, as you guys do some cool things, which
Oh,
we're
yeah,
not going
for
to touch
sure.
on all of them, but like
No.
some of the ones you guys are doing on buying businesses, I'm trying to follow in your footsteps. It's probably a journey you'll have to get me back on the show for when we go down that route, because I will use you guys for helping me transact. But those transactions are cool, but at the end of the day, you feel more comfortable making those transactions, making those moves as a business owner, because you've got income coming in from real estate and from other investments. And I think it just gives you a lot more flexibility when you're able to sort of add arsenal to your opportunities.
You ask me, the true definition of wealth is having those multiple streams of income. And you got to do that through multiple properties, multiple businesses, multiple passive investments, multiple active investments. It all comes together to create your own retirement.
And then you get to tell the crappy clients that they can go,
You nailed it. So, well, thank you for coming today. Really appreciate it. I'm looking forward to our next time. Please check out the next video where we're actually going to be celebrating or crying.
None of that.
Hopefully.
Yeah.
I mean, the reality is if the deal doesn't turn out the way you think it will, you're not going to move forward with the closing.
You got a great point. And I think that on any of these older deals, the proof comes out of this diligence phase that you got to see a little bit of, but that we're not through yet. So,
and again, that's what it is. Like you dive in deep, but retrades, problems with financing, I'm not going to say that, and I wouldn't say that it's 100% sure thing you're going to close.
Absolutely not.
I can't wait to celebrate with you.
Let's go.
Because this one's going to work out.
Let's go. I feel good about it.
Definitely check out the next video where we are celebrating a deal gone right.
Thanks, Nick.
Thank you.
That was cool.